Last week, Google reported one of the best quarters in its history. Cloud grew 82%. They beat on revenue. They beat on margins. And the stock got sold hard. Days later, South Korea's entire stock market fell so fast they had to shut it off. A nearly 11% crash, trading halted 20 minutes. The eighth emergency stop this year. Japan's in a correction, so here's the question. Nobody on the news can answer. If the AI dream is real, and Google just proved it's real, why is everything crashing? I'm going to show you the answer. It's not the dream, it's the bill. And once you see who's being forced to pay it, you'll understand why I think this ugly, violent week is the setup we've been waiting on, and exactly what would prove me wrong. Let's go. Here's the receipt. Cloud grew 82%. The demand call is over. Google won it. But look at the other two bars. Quarterly capital spending, $44.9 billion, and free cash flow just went negative, minus $5.9 billion. Google's first negative quarter since 2004. The dream is real. The bill is what's breaking the market. Look at what that did to the stock. Alphabet closed at $342 the day of earnings. The very next day, $318, a 7% drop, tens of billions in market value gone, on a quarter that beat revenue, beat margins, and grew cloud 82%. That's not a demand problem. That's the market pricing in the cost of the build-out. And this isn't just a stock story. Look at credit. High-yield spreads have widened over the past several weeks. Credit investors are starting to demand more compensation for risk. The same bill that's hitting AI stocks is showing up in the bond market too. When credit and equities move together like this, that's not noise. That's the market repricing risk across the board, not just punishing one sector. Before you take my word for any of this, look at the ledger. June 12th and 13th on our AI page. We flagged CapEx digestion as a forward risk and told you to watch CapEx guidance. Korea and SK Hynix stress arrived. July 7th through 17th on the rotation page, AI isn't over, but the easy trade is. SOXL fell 20% that week alone. Semis and DRAM got hit. It's kept falling since, down 42% from where that call was made. July 16th by email. Semis cooling, BTC setup if liquidity turns, core CPI cooled that same week, and BTC and hype got hit as collateral anyway. And July 28th, the current tape. Forced unwinds can drag BTC and hype first. That's exactly what happened. We publish these calls before we know if we're right, including the days the data was against us. That's the whole point of keeping a ledger. Now the carnage, close to close, no cherry-picked intraday lows. The Kospi, down 25.9% from its June 22nd peak. SK Hynix, down 37.8%. Samsung and SK Hynix alone are now roughly half the weight of that entire index versus a quarter at the end of last year. When the AI trade sneezes, Korea catches pneumonia. And this morning, live proof it's still happening. SK Hynix just reported a record quarter. Operating profit up 557% year over year. And the stock still got hit because HBM4 shipments ran late. That's not a demand miss. Customers are asking for more supply. SK Hynix raised its CapEx guidance and signed new long-term deals with 10 major clients. Read that carefully. The market punished a record quarter over a shipment timing issue. That's not the AI trade dying. That's the purge still running. And while Korea was posting its worst two-day stretch in market history, look at Bitcoin. Same window, completely different tape. Bitcoin climbed towards $64,000, up roughly 1%, while Samsung fell 13.4%, its worst day in about 20 years, and SK Hynix fell nearly 15% intraday. CoinDesk's own read on this. It's the second time in 5 sessions Bitcoin has held flat or green straight through an AI stock route. That's not luck twice in a week. That's a decoupling signal. Now look at what the AI trade did to itself before Korea even got hit. SOXL, the leveraged semiconductor fund, peaked at $301 on June 22nd. This morning it fell to $92. That's a 69% collapse in 5 weeks. Here's why that's not a crash call. A purge this violent, this fast, in the most crowded trade of the year, is exactly what happens right before leadership rotates. The demand doesn't disappear. SK Hynix just told you that themselves, customers are asking for more chips, not fewer. What disappears is the premium everyone was paying to own the story. And underneath all of it sits a bond market that still hasn't priced in how much the real economy has actually slowed. Weak hiring, a Fed decision this afternoon, and yields still acting like nothing's wrong. When that gap closes, capital doesn't sit in cash. It moves to whatever already proved it could survive the purge. Slowdown, not collapse. That's the opportunity, and it's why now, not later, is when you get positioned. And this wasn't a wiggle. Look at the levered AI and semi-ETF stack. SOXL down 20% on the day. Bulls down 12. TCL down 11. Triple leverage products don't get scared, they get forced. That's machines selling into a falling market, not investors making a decision. And look at the spread across individual names. This is what tells you what kind of selling this actually is. Nvidia and Broadcom barely scratched, down 1 and 2%. Dell, Micron, Marvell, down 10 to 14. That's not a uniform verdict on AI. That's the most levered, most crowded names getting purged hardest, the signature of a margin call, not a demand collapse. Put it on one board. The names everyone calls safe. National champions, the hot funds, the cheap PE darlings, down 11, 13, 15, 20% in a session. The asset everyone calls volatile, down 1. Even our highest beta holding out held the unstoppables. Remember this board the next time someone tells you which side of this is risky. Here's the part almost nobody is showing you. 90 days ago, these two started from the same line. Semis went vertical, up 60% at the peak, while Bitcoin took its medicine early and quietly. Now watch the right edge. The AI trade is collapsing back toward the line Bitcoin already cleared. Bitcoin took its correction first. The AI trade is taking its correction now. That's not weakness, that's a head start. And on the trailing scorecard, time frame by time frame, Bitcoin is roughly flat while SOXL is down 54% over the last month. I'll be straight about that scorecard window. It starts near Bitcoin's own June floor. That's favorable by construction. The claim isn't that the window is unbiased. The claim is that Bitcoin bottomed first. And the 90-day chart is what actually shows that. And the honest read on the relationship itself, Bitcoin's rolling correlation to the semis trade is noisy, not one way. It swung from 0.6 to negative and back multiple times this year. Right now, it's 0.26, below the 6-month average of 0.36. Bitcoin isn't chained to the AI trade. Some days it trades like collateral. Most days it doesn't. So why is the AI trade actually cracking? 4 dated, named institutional sources, no anonymous accounts, no screenshots of a feed. Fitch's Global Risk Outlook published yesterday. The scale of AI investment means a correction is now a top global credit risk. Alphabet's own SEC filings. CAPEX up 7.1 times in 13 quarters, a commitment problem, not a demand problem. FINRA's June margin statistics. Total customer margin debt at a record $1.5 trillion, up almost 8% in a single month. Leverage was already stretched before this started. And Bloomberg and Axios reporting this week that Nvidia is weighing roughly $250 billion in financing guarantees for OpenAI plus $350 billion in GPU purchase financing, the kind of chip supplier as banker structure that revives circular financing questions. That's the financing side of this unwind. Credit default chatter on the most levered AI builders is sitting at extreme levels. I'm not putting an unverified number on your screen, but the direction is real and it's worth watching. And we don't have to guess what happens next. The next 24 hours are the fork. Microsoft reports today after the close, the same day as the Fed's 2 o'clock decision this afternoon. Amazon reports tomorrow after the close. And here's the warning SK Hynix just gave us a few hours before I recorded this. A record quarter still got punished because the market is trading on the excuses, not the beat. If Amazon's numbers are good tomorrow and the market sells it anyway, that's not an Amazon problem. That's the same repricing hitting a new name. And it argues for rotation, not retreat. Watch exactly 2 things. Is AI demand still showing up in the numbers? And is capital spending disciplined enough that cash flow holds? If they pass, the forced selling burns out fast. If they fail, this becomes a financing story, the purge runs longer, and the rotation starts later, from lower. I'll take either outcome. Everything so far was the autopsy. Now, the opportunity. While everyone stared at the crash, the Fed's hawkish case quietly got messier, not cleaner. Pillar 1 was oil, 86.99 a week ago. Monday, spiking above 100 intraday on Thursday amid Iran strike fears, then sliding for 3 straight sessions to its lowest level in more than a week as Washington and Tehran appeared to stand down. And then, overnight, Iran launched a fresh missile attack on U.S. forces in the Middle East. Every missile was intercepted. Oil jumped right back. The stood down story that traders were pricing in yesterday afternoon didn't survive the night. That's not a market that's found its answer on Iran. That's a market getting whipsawed by a conflict that isn't over. And the Fed has to set policy through that noise, not around it. The futures curve still says this doesn't last forever. WTI for December 2026 is pricing near $74. June 2027 near 70, December 2027 at 68. The market still thinks the premium fades. It just isn't fading as fast or as cleanly as it looked yesterday afternoon. Pillar 2 was hot inflation, but core CPI just stopped rising, 336.121 in May, 336.065 in June, essentially flat. Friday's PCE print covers June. The month oil was still calm before this week's spike. That's a cooling read walking into the Fed, not a rate cut promise, a receipt. And here's the third receipt, and I want to be honest about the whole arc. Not just the part that helps me. We flagged June's jobs shock the day it printed. Payrolls at 57,000 against 115,000 expected. But look at what came before and after. A hot spring, 3 straight upside surprises had markets actually flirting with pricing a hike, not a cut. Then June's miss. Then stabilization. Unemployment eased back to 4.2%. And the latest initial claims print, 187,000, is the lowest since April. Labor bent, then steadied. It's a crack in the Hawks story, not a collapse, and we'll say so either way. So here's today, 2 o'clock Eastern. This afternoon, the Fed decides. Nobody is pricing a cut. Economists expect them to hold for a 5th straight meeting. A central bank talking tough into a purge week, with a labor crack behind it and an oil shock that flared up again overnight, is how pivots have started before. Watch the 2-year Treasury, not the podium. And underneath it all, the money supply keeps climbing. M2 at a record $23 trillion, rising every month this year. Bitcoin ETFs just posted their 3rd straight week of net inflows. The liquidity backdrop we flagged July 16th hasn't gone away. It's building while everyone's watching the AI carnage. Now, the pattern that matters most, and I want to be careful with it. The last full cut cycle started in September 2019. Bitcoin ran 5.8 times from that first cut, even surviving a COVID crash inside the window, and got there in a bit over 2 years. This cycle's first cut was September 18th, 2024, when Bitcoin closed at $62,960. That's the date printed right on the chart, not a vague cuts resumed. Today, 22 months in, Bitcoin is roughly flat versus that first cut level. Zoom out on the cycle itself. This one started out exactly like you'd want. Bitcoin pricing and rate cuts, a real cycle underway. What knocked it off course wasn't the thesis breaking. It was 3 shocks landing back to back. An oil spike, the Japan yen carry trade unwind, and a sudden fear of rate hikes instead of cuts. Those are the things fading right now, not the cycle. Think about how long it actually takes to get the Fed funds rate down to 2 or 3%, if we get there at all. That's years, not months, which means the setup that stalled this cycle is running out of road, and a fresh multi-year Bitcoin cycle, one that likely started at this year's bottom, is just getting going. The 2019 cycle ran up 550% by month 27. We're calling the start of this one, not the top. This is the pattern that pays off when a crowded trade dies. 2000, the torch passed to gold. 255 to 1900 over the decade. while the NASDAQ spent 15 years round-tripping. 2022. Bitcoin bottomed November 21st, 5 weeks before the NASDAQ, then ran 167% while the NASDAQ did 47%. I can't promise a third handoff. I can show you the last two. And hype, the highest beta expression of this whole setup, moved about 3 times Bitcoin yesterday. That's beta doing exactly what beta does. And here's the part nobody says out loud. Even at 3x beta, hype fell less yesterday than SK Hynix, a $200 billion national champion, less than Samsung, and a quarter of what the triple-levered semi-funds lost. The volatile asset outheld the safe ones. The same beta that stings on the way down is the engine on the way up. Korea turned its market off for 20 minutes yesterday. The venue behind hype has no off switch. It traded through the whole thing. Which is why Rebel Dividends is built the way it is. Bitcoin as the rotation's destination, hype as its high beta expression, and RD as how you sit in that setup while getting paid weekly as it forms. Not a promise, a position. And for the record, crypto assets are volatile and can lose value. You watched that yesterday. And dividends, while paid weekly, are never guaranteed. Because conviction without a tripwire is just noise. Screenshot this. 1. Microsoft or Amazon crack on AI demand or CapEx discipline in this week's reports. Watch the inverse 2. Semis reclaiming their highs or Microsoft and Amazon calming the tape counts as supporting evidence the purge is burning out, not a separate tripwire. 2. The 2-year Treasury rises through Wednesday's Fed and Friday's PCE. 3. Bitcoin prints a decisive daily close below 58,000. 4. AI credit stress spreads beyond a name or two. 5. Hyperliquid loses its volume lead. 6. The yen snaps violently stronger and drags everything with it. 6 tripwires. Filed July 28th. Graded on this channel. So no, I don't think this is the crash. I think it's the margin call that clears the runway. Google proved the dream. The purge is pricing the bill. And the rotation forms in the wreckage. Today, the Fed at 2, Microsoft after the close tonight, tomorrow. Amazon, the Bank of Japan, the Bank of England, Friday, PCE. We'll be here for every single one. No webinar this week, next Tuesday, August 4th, 3:30 Eastern. We're live. And we grade this exact video against those 6 tripwires. I'm Jason Cox. Thanks for watching.